Today, the buy now, pay later conundrum. Hello again, it's Martin North from Digital Finance Analytics, with latest posts covering finance and problem news with a distinctively Australian flavour. Well, I've been watching the buy now, pay later segment for quite a long time, and of course there's been phenomenal growth. And some of the things that I see from my surveys are quite concerning. We know that around 20% of users of buy now, pay later are ending up paying big fees because they don't keep up with repayments. Yet, of course, these are not regarded in Australia as credit-related products, and there's been considerable growth, although recently we've seen some of the performance of buy now, pay later stocks fall. That's true here and overseas, partly because households are getting themselves into more financial difficulty and therefore the delinquency rates are going to rise. But APRA had some interesting things to say yesterday about what banks should do with regard to buy now, pay later obligations with regard to their loan assessments and reporting. In fact, they said that banks will now need to include buy now, pay later, and also higher education debts when reporting debt-to-income ratios to the regulator from September. So the regulator released the new framework, which updates APRA's prudential standard for credit risk, the APS 220 Credit Risk Management and Macroprudential Policy Credit Measures, and it's effective 1 September 2022. The aim of the new requirements, they say, is to strengthen the transparency, implementation and enforceability of future policy responses to systemic risks. The changes, which aim to ensure that banks are operationally prepared to implement certain macroprudential policy measures if needed, particularly focus on limiting growth in, quote, higher risk residential mortgage lending, such as loan to high debt to income multiples or high loan to valuation ratios. And writing to the ADIs, Wayne Byers, the chair of APRA, noted that the amendments now make clear that banks should be including higher education contribution scheme debts and buy now, pay later debts in their debt-to-income ratio reporting. And he explained that the changes came after questions were raised by banks following industry consultation last year regarding how they should be treating buy now, pay later, or the HECS help debt. Despite rising popularity, buy now, pay later has been somewhat of an outlier in regulation and is not regulated under the National Credit Act like normal debt mechanisms, as providers do not charge interest on repayments. Some ADIs sought clarification as to whether buy now, pay later or HECS help debt should be treated as debt for the purpose of DTI reporting, Mr. Byers said in the letter. Under reporting standard ARS 223, residential mortgage lending, debt to income is defined as the ratio of the credit limit of all debts held by the borrower to the borrower's gross income. To ensure a consistent approach is taken across the industry, APRA has clarified that HECS help loans and debt incurred through buy now, pay later schemes should be included in the DTI ratios. The DTI would therefore be the ratio of the credit limit of all debts held by the borrower to the borrower's gross income, annual before tax income verified by ADI, excluding compulsory superannuation contributions, and before any discounts or haircuts under the ADI's serviceability assessment policy. APRA clarified that this should include the credit limit of any debts, such as other mortgage lending, personal loans, credit cards, consumer finance, margin lending, buy now, pay later, higher education, help programs, or higher education contribution scheme, in other words, HECS debts, and any other debts held by the borrower to any party to the extent that this is known to the ADI. The new requirements are aimed at strengthening the transparency, implementation and enforceability of future policy responses aimed at reducing financial stability risks. The APRA chairman emphasised the importance of lenders actively managing the risks within their loan portfolios, stating, in the current environment, with high household indebtedness and rising interest rates, it's essential for banks to prudently and proactively manage risks in residential mortgage lending. APRA expects lenders to closely monitor housing lending risks to ensure that aggregate portfolio risks remain within their risk appetite and that standards for new lending remain prudent. Now, I was taken aback by this because I would have thought that lenders should already be doing this. After all, they need to understand the total household debt position. Unfortunately, we know from our own experience and our surveys that many households have loans that are much bigger than their debt to income ratio would really allow them to get. And that's because not all of those loan categories were necessarily always included. Some of it was adjusted thanks to waivers. Some of it was done because they never asked the question in the first place. So this is an important clarification from APRA, but of course it's not retrospective, and there will be a number of loans out there that will now be revealed as bad loans later, I think, simply due to those other debts being in the system. And the fact that buy now, pay later was not necessarily by lenders seen as something to consider when considering lending underwriting standards is frankly pretty astonishing. But then again, I don't get astonished very easily these days because the bad lending practices amongst the lenders are still very prevalent, unfortunately. And as interest rates rise and cost of living rise, I think we're going to see some of this coming out in the wash in due course. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.